Wall Street is opening a new trading week on the same pessimistic note. Investors are unable to find fundamentals to regain the appetite for risk. The macroeconomic environment still arouses risk aversion. Following a massive capital outflow from the stock market last week, Wall Street is overwhelmed by the doom and gloom in the pre-market. Importantly, the S&P 500 briefly dipped below the psychological level of 4,300 points. The benchmark stock indexes closed the failed week at new lows. The three stock indexes suffered losses. The Dow Jones slipped by 0.31%, the Nasdaq inched down by 0.09%, and the S&P 500 fell by 0.23% to close at 4,320 points. The indexes went lower in a negative territory in the pre-market today. Futures on the stock indexes declined by 0.4 and 0.45%. The S&P 500 is expected to trade in the intraday corridor between 4,270 and 4,320 points. The major indexes wavered between dips and gains on a Friday, but closed lower. The hawkish Federal Reserve, rising yields over U.S. Treasuries, and the looming closure of the government pushed the U.S. stocks down by 6% from the highs of late July. On Thursday, the S&P 500 dipped below its 10-day moving average, the key support for the first time since March. And the index fell to settle above this level. It means that the index remains under selling pressure. And the three stock indexes closed with weekly losses. The S&P 500 and the Nasdaq looked the sharpest weekly losses since March. Member of the Board of Governors Michelle Bowman made hawkish remarks on a Friday. She advocated for the higher funds rate and proposed to keep it at elevated levels for an extended time in order to bring inflation firmly down to the official target level at 2%. In the corporate sector, Ford Motor shares added 1.9% after the stricken United Auto Workers Union reported progress in negotiations with the automaker. Activization Blizzard shares gained 1.7% following a statement from the UK's antitrust body that Microsoft had restructured its $69 billion acquisition of the company, opening the door for the largest gaining deal in history. Of the 11 major sectors of the S&P 500 index, the consumer goods sector suffered the steepest percentage losses, while the technology and energy sectors were the only ones to rise. And the S&P 500 index fell by 2.9% last week. According to Bank of America, there was an outflow of $18.96 billion from stocks over the past week, marking the largest weekly outflow since December 2022. Wall Street seemed poised to start the new week no better. The factors that led to the losses in the benchmark indexes last week have not disappeared as investors are stoking the anxiety and fears. The Federal Reserve's preferred inflation indicator and the PCE price index will be released on September 29th. It will be the report of crucial importance as the Fed relies heavily on it. Given that oil prices sharply increased again this March, the inflation picture has become complicated. U.S. crude oil prices have retained much of the September surge, having gained 15% from a year ago. Besides, a series of important data and speeches by Fed policymakers are expected later this week. Investors are also trying to assess other risks, including a potential government shutdown if lawmakers fail to pass a budget by September 30th. Congress has yet to finalize any of the 12 regular spending bills to fund federal agency programs for the next fiscal year. The absence of an agreement by October 1st means that Washington will run out of cash to keep the government fully operational, and the US dollar is still flexing its muscles. The greenback is holding the upper hand over all major currencies. The index climbed to a new high of 105.90. The intraday Canada for the instrument is seen between 105.70 and 106.20. Last week, the US currency found support from the Fed's policy decisions. At the same time, the ECB and the Bank of England discouraged traders. Today, the soft euro and the pound sterling are extending the losses. The risk aversion is also triggered by concerns about the property market in China. Bearing all the fundamentals in mind, the outlook for the US dollar remains bullish. A confident rally of the US dollar and weakness over oil prices are putting minor pressure on the Canadian dollar. The USD card pay is hovering around the level of 1.3480. The instrument is expected to trade in the intraday Canada between 1.3460 and 1.3520. Crude oil is trading mixed today amid the anxiety among investors. All in all, oil prices are mainly flat today. Oil prices took a nosedive last week as the hawkish rhetoric of the Federal Reserve agitated financial markets, and the Fed's policy statement halted the three-week rally in the oil market caused by the joint decision of Saudi Arabia and Russia to extend oil output cuts until the year end. The crypto market is trading without a clear-cut trend, awaiting a tailwind. Bitcoin is carrying on with its decline, though the token managed to settle above the psychological level of 26,000. It's now trading at 26,150. 0.3% down. General risk aversion is also impacting the cryptocurrency market, which continues to show an inverse correlation with the dollar index. An approval of an ETF could breathe life into crypto assets rather than just sustain them, but for now, no miracle has occurred. For the time being, there are 10 active applications for spot Bitcoin ETFs, excluding Grayscale's application to convert GBTC into a spot Bitcoin ETF. Speaking for the intraday Canada for Bitcoin, if the asset can hold about 26,000, it could well recover to 26,400 and $26,600. A drop below $26,000 might send the token down to $25,650 once again. We wish you gainful trading too, no matter what trend is unfolding. Feel free to leave your comments and ask any questions, and see you online tomorrow.